You know, healthcare is just transforming at an incredible pace right now. It's moving so far beyond those traditional models into something much more personalized, much more accessible.
It really is quite a shift.
And right in the thick of that transformation. HIMS and Hers Health, Inc., or HIMS. Welcome, everyone, to a deep dive into this really fascinating company.
Definitely fascinating.
Yeah, this isn't just about a business. It's about this compelling intersection of telehealth, technology, and direct-to-consumer healthcare. It's reshaping how millions access care.
Absolutely.
We've spent time unpacking a really comprehensive research report from Compasscope, and we've also looked at recent business updates, their latest earnings call transcript, basically trying to pull out the most vital insights for you.
Getting to the core of it.
Exactly. Our mission today is to cut through the noise, give you a clear, well-informed perspective on HIMS, what their business is, the competitive landscape, their, frankly, ambitious growth strategy.
Very ambitious.
The significant risks they face, and we'll definitely get into a recent high-profile dispute and, what to really watch going forward.
And I think what's truly compelling here is how HIMS is really trying to democratize access to specialized healthcare, often in areas that historically have been kind of underserved or just difficult for the average person to navigate. We'll dig into the strategic choices that have fueled its rapid growth, but also, as you said, exposed it to some pretty unique challenges.
Okay, let's start there then. Let's unpack this.
Yeah.
At its core, what exactly is HIMS and Hers Health?
So, at its heart, HIMS is a consumer-focused digital healthcare platform. Think of it like an end-to-end service.
End-to-end, meaning?
Meaning it combines the telehealth consultations, the prescription medications, diagnostics, wellness products, and even the fulfillment. It's all vertically integrated.
Oh, yeah.
Their goal is personalized, affordable care across these high-demand areas.
Right, these high-demand clinical and wellness categories.
Right.
What are they? Can you give us the breakdown? Because it sounds quite broad.
It absolutely is broad, and that's, a key part of their strategy. First up, you have their core medical specialties.
Okay.
This covers areas like sexual health, think ED, premature ejaculation, libido, also extensive dermatology services for both men's and women's skin, hair, and a strong presence in mental health for anxiety, depression, therapy.
Familiar ground for many telehealth companies.
Yes, but they also offer primary care, general health concerns, allergies, even COVID-19 treatment. Then they move into what they call advanced clinical and hormonal specialties.
Okay, this sounds newer.
It is. This is where you see these rapidly growing areas like metabolic health, which includes weight loss.
Ah, the GLP-1s and related treatments.
Exactly. They offer oral treatments, liraglutide, semaglutide, and they even had a partnership for branded Wegovy, though we'll talk more about that later.
Right.
They also address hormone health, think low testosterone for men and women's health, specifically menopause support and hormonal imbalance care.
So really expanding beyond those initial wellness areas.
Definitely. And beyond that, they're leaning heavily into preventative and diagnostic services. They offer at-home lab testing, full-body blood tests, checking heart, hormone, liver, thyroid, prostate biomarkers.
Oh, wow, actual diagnostics at home.
Yeah, and wellness monitoring tools, BMI trackers, hydration, movement, nutrition, sleep, that kind of thing. Now, a crucial differentiator, something that really sets them apart, is their fulfillment and pharmaceutical services.
You mentioned vertical integration. This is part of that.
This is a huge part. They have in-house pharmacy services, mail order, personalized compounding, and even sterile injectable preparations.
Compound, that sounds complex.
It is.
Yeah.
They even have a dedicated peptide compounding and R&D facility. That's a strategic bet on future areas like metabolic optimization, cognitive performance.
Looking ahead.
And underpinning all of this, their platform technology and AI tools, their MedMatch AI engine helps providers optimize treatment and diagnosis.
AI in healthcare, a hot topic.
Very. And they're actively developing AI-powered virtual health coaches, therapists, nutritionists, trying to enhance that personalization.
Okay.
Finally, they have international and partnership initiatives, early expansion in the UK, and those branded pharma collaborations we mentioned, like the one previously with Novo Nordisk.
Wow, okay, so it really isn't just a telehealth app. It's this whole ecosystem, vertically operated, consultation to fulfillment, using tech, AI.
That's the picture, an entire integrated system.
That vertical integration you mentioned, it sounds like a really big deal. What gives HIMS its competitive edge there, and where do they face challenges because of it or despite it?
You're right, that vertical integration is absolutely central. Controlling the whole process gives them advantages in margins, the user experience, and frankly, speed to market.
Okay, so what are the specific advantages?
Well, personalization at scale is huge. They have over 300 personalized treatment stories now, aiming for thousands. And get this, 70% of new subscribers in Q1 2025 chose a tailored care plan.
70%, that's high.
It is. And they're using clinical data, biometric data, behavioral data, leveraging tech to make personalized care profitable at scale. That's something traditional healthcare really struggles with.
Right, the economics are tough usually.
Exactly. Then there's their proprietary technology and AI. That MedMatch engine, the AI assistant tools, they're built for long-term user retention.
Sticky customers.
Hopefully. They also have strong brand equity in DTC marketing. It's a recognized direct-to-consumer brand. And their marketing is super efficient, like single-digit month payback periods.
That's incredibly fast payback.
It is. Plus, economies of scale and operational efficiency. Nearly 2.4 million subscribers in Q1 25, investments in automation. It's pushing their adjusted EBITDA margins up, almost 16% in Q1, and they're targeting 20% by 2030.
Okay, so efficiency is key.
Absolutely. And finally, their specialty breadth, expanding from just men's wellness to this broad range. Each major specialty is projected to hit over $100 million in revenue in 2025. That's significant diversification.
Okay, those are some strong points. But what about the flip side? The challenges?
Definitely challenges. Regulatory scrutiny on compounding is a major one, especially for GLP-1s. Now that the FDA declared the semaglutide shortage over, legal fights with big pharma are a constant, significant risk.
We'll definitely need to dig into that compounding issue more.
Oh, we will. There's also transition risk post-GLP-1 shortage, potential revenue pressure, maybe losing subscribers if customers don't smoothly shift to their other offerings, the oral kits, liraglutide, or trying to get branded Wegovy.
Makes sense. People might just go back to the original branded drug elsewhere.
Could happen. Then there's their dependence on out-of-pocket consumer demand. They're largely cash pay. That makes them sensitive to economic downturns, unlike competitors who work with insurance.
Right, discretionary spending.
Exactly. Scaling risk in new specialties, too. Moving into complex areas like hormone health or longevity, that needs really precise care, tight operational coordination. It's not easy.
And competition.
Always a risk. Competitive entry risk. You've got giants like CVS Health, Amazon Clinic.
Yep.
They could try to enter or replicate the model, leveraging their existing infrastructure.
So how do they actually stack up against some of these names right now?
Good question. Let's compare. Versus Teladoc Health, HIMS has, I'd argue, superior vertical integration, that direct consumer focus, stronger brand, better profitability. Teladoc is much more focused on employers, insurers. Their tech stack is more fragmented.
Okay. What about Roe? They seem similar in some ways.
Similar, but HIMS has more scaled pharmacy and fulfillment, broader specialty diversification. They've invested more in proprietary tech and AI. Roe relies more on third-party outsourcing for some key functions, lacks HIMS' scale there.
Got it. 30 Madison.
HIMS is more horizontally integrated across lots of conditions, stronger brand consistency, deeper infrastructure. 30 Madison is more vertically specialized, condition by condition. Think Keeps for hair loss, Co for migraine.
Right, niche brands under one umbrella.
Exactly, versus, say, Weight Watchers or Noom. HIMS offers medication-based, clinically supervised treatments. They capture much higher revenue per subscriber. That ARPU, average revenue per user, is $84 a month for HIMS. WW and Noom are primarily behavioral, lifestyle-focused.
Different models entirely.
Pretty much. And lastly, versus Amazon Clinic or CVS Health. These guys leverage their physical footprint, their payer relationships, but they generally lack HIMS's level of personalization, that vertically integrated specialty fulfillment, and frankly, the DTC brand sophistication.
So boiling it down,
HIMS's defensible advantage seems to lie in its integrated tech-powered platform emphasizing personalized treatments at scale, backed by that strong brand and good unit economics. But, and it's a big but, staying ahead means navigating complex regulations and successfully expanding into these new, tricky specialties.
That paints a really clear picture of where they stand.
Yeah.
But where are they heading? What's the big vision for growth? They sound ambitious already.
Oh, they are. HIMS has publicly set some incredibly ambitious long-term targets. We're talking $6.5 billion in annual revenue and $1.3 billion in adjusted EBITDA by 2030.
$6.5 billion. Wow, that's nearly 6 times their FY 2024 revenue levels.
It's a massive leap, requires tremendous execution.
So how do they plan to get there? What are the pillars of this growth strategy?
Their key strategic growth pillars are pretty clear. First, specialty expansion, adding new clinical verticals, Weight loss, obviously, low testosterone, menopause support, eventually maybe even longevity care.
Hmm.
And those legacy specialties, mental health, sexual health, dermatology, they expect each to hit over $100 million in revenue in 2025 alone.
So expanding the menu significantly.
Exactly. Second, personalization and SKU diversification, going from hundreds of personalized treatments now to potentially thousands. The goal is higher revenue per subscriber by offering multi-condition solutions, bundling things together.
Or value per customer.
That's the idea.
Yeah.
Third, integrating lab diagnostics. They made an acquisition here. This is crucial for enabling precision medicine, biomarker-led personalization, making treatment choices based on your actual lab results.
More data-driven care.
Precisely. Fourth, ongoing technology and AI investment, pouring money into MedMatch AI, developing those AI coaches and therapeutic assistants to deepen engagement and hopefully improve outcomes.
The tech backbone.
Critical. Fifth, and this is huge logistically, infrastructure investment, expanding their pharmacy and fulfillment footprint to 700,000 square feet by the end of 2025, upgrading automation, sterile compounding facilities, a major undertaking.
700,000 square feet, that's enormous.
It really is. Shows the scale they're aiming for. Sixth, partnerships and pharma collaborations, like that Novo Nordisk deal for branded Wegovy they launched, though obviously that's hit a snag. But the potential for more pharma collaborations is there.
If they can navigate those relationships.
A big if. And finally, global expansion. They've got early traction in the UK, signaling their international ambitions.
Okay, ambitious targets, clear pillars. But you mentioned the Q1 2025 earnings call. Did that give you confidence they're actually on track for these huge goals?
It certainly showed strong momentum. Revenue more than doubled year over year to $586 million. Adjusted EBITDA nearly tripled to $91 million, hitting that 16% margin.
Strong numbers.
Very. Subscriber base hit nearly 2.4 million, with over 1.4 million using personalized solutions. And importantly, this company has a track record of beating expectations. They hit their 2025 $1.2 billion revenue target a whole year early.
Okay, so they've executed well in the past.
They have. That history definitely gives them and investors some confidence. But, like we said, such ambitious growth, especially this fast, it always raises the question of risk. Execution risk.
All right. Scaling at this pace, especially with such a complex, vertically integrated model,
Yeah.
it has to come with significant challenges. What are the main execution risks you see?
Yeah, HIMS faces, I'd say, moderate to high business execution risk, largely because of that aggressive expansion and deep vertical integration. It creates complexity.
So what are the specific risks?
Top of the list probably is regulatory compliance risk. Operating with compounded medications, especially GLP-1s, requires super strict adherence to FDA's 503A rules. And those rules, as we'll get into, are under a microscope right now.
The compounding issue again. Okay.
Then there's infrastructure expansion risk. Rapidly scaling up to 700,000 plus square feet of fulfillment space by year-end 2025. That introduces real operational risks. Cost overruns, integration headaches, things just not working smoothly.
Big construction and logistics project, basically.
Essentially, yes. Alongside building complex pharmacy operations, specialty expansion risk is also substantial. Moving into tricky clinical areas like menopause or longevity, that demands high-touch coordination, very precise formulary development. Mistakes here could be costly, clinically, and financially.
Higher stakes in those areas.
Much higher. There's also consumer engagement risk. Think about transitioning existing users, say, in sexual health, from just buying something when they need it to signing up for a daily personalized treatment subscription.
Getting them to commit long-term.
Right. If that transition isn't managed carefully, it could temporarily slow growth or hurt retention. Then you have laboratory diagnostics and peptide operations. These are newer segments for them, require new skills, new supply chains, R&D expertise. Potential for errors is higher initially.
Learning curve involved.
Definitely. AI-led product evolution also carries risk. Developing proprietary AI tools like MedMatch, those virtual coaches. There's tech execution risk, does this actually work well, plus regulatory acceptance risk, and crucially, patient safety concerns.
AI in healthcare needs to be perfect.
Or very, very close. There's marketing efficiency risk too. Big campaigns like that Super Bowl ad they ran.
Yeah.
They need strong conversion to justify the cost, especially as the market gets crowded.
Keeping customer acquisition costs low.
Vital. And finally, talent and leadership transition. They've had recent executive changes, like bringing in a new COO, Nader Kabani from Amazon. That always introduces some transitional integration risks while new leadership settles in.
So it sounds like, compared to peers who might outsource more, HIMS has higher operational and regulatory complexity because they own so much of the process themselves.
That's a great way to put it. It's their strength, but also a source of significant execution risk.
Okay, and speaking of that regulatory complexity, let's dive into that really significant, timely issue. The dispute with Novo Nordisk over compounding. This has huge implications for HIMS. How did this whole situation even come about?
Yeah, this is crucial context. The story really starts back in June 2021. That's when the FDA approved Wegovy, the brand name for semaglutide, specifically for weight management.
Right, the big blockbuster drug.
Exactly. Demand just exploded through late 2021 and 2022. But Novo Nordisk ran into manufacturing issues, leading to severe supply shortages. And this is the absolute key point. By March 2022, Wegovy and later Ozempic, too, were officially added to the FDA's drug shortage list.
And that's when compounding pharmacists could step in.
Precisely. From 2022 up until early 2025, these specialized pharmacies, both 503A pharmacies, which compound based on individual prescriptions, and 503B outsourcing facilities, which are larger scale, they began compounding semaglutide injections.
And this was legal.
Yes, because of the shortage. There are specific sections in the Federal Food, Drug, and Cosmetic Act 503A and 503B that normally prohibit making a copy of an approved drug. But those prohibitions are suspended when a drug is on the official FDA shortage list.
Ah, okay, so the shortage created a temporary legal window.
Exactly, a window that many, including suppliers for HIMS, utilized.
So it was legal due to the shortage, but then what changed? The shortage didn't last forever.
No, it didn't. And the tide turned pretty quickly. In August 2023, the FDA issued a safety alert about potential impurities found in some compounded semaglutide. That raised red flags.
Oh.
Then, in October 2024, Novo Nordisk itself petitioned the FDA to halt the compounding altogether and started actively suing several compounders alleging trademark and patent violations.
So the manufacturer started fighting back.
Aggressively. But the really critical date was February 21st, 2025. That's when the FDA officially declared the semaglutide shortage resolved. Over.
And that closed the legal window.
Instantly. It meant the legal exception for compounding ended. The FDA told 503A pharmacies to cease new compounding by April 22, 2025, and the larger 503B facilities by May 22, 2025. And enforcement has begun. Novo Nordisk has already secured permanent injunctions against some compounders.
Wow. It's fascinating, though. You mentioned Novo used trademark and unfair competition laws.
Mm-hmm.
So even if patent law didn't explicitly block compounding during the shortage, they found other ways to go after compounders.
Yes, that's a key legal tactic. They argued that compounders were creating confusingly similar knockoff products using names similar to Wegovy or Ozempic and essentially piggybacking on their brand reputation and marketing investment.
Interesting angle.
And it's worth noting, this kind of large-scale compounding of a patent-protected blockbuster drug, it's actually pretty uncommon. The semaglutide situation was really notable for its sheer scale and how quickly things snapped back once branded supply improved.
Okay, so bringing it back to HIMS. What was the direct impact on them when the shortage ended and when Novo Nordisk terminated that partnership they had just started? Sounds like a double whammy.
It absolutely was a major double blow, hitting them almost simultaneously. First, the FDA ending the shortage in February 2025. That meant HIMS had to wind down its low-cost, private-label compounded semaglutide program. That was a high-margin source of supply for them, underpinning their more affordable GLP-1 plan.
So their costs went up immediately.
Significantly, it directly eroded their price advantage and squeezed their margins. Second, Novo Nordisk terminated its commercial partnership with HIMS on June 23, 2025. This was brand new, only 3 months old. It was supposed to give HIMS access to offer branded Wegovy directly.
And Novo pulled the plug. Why?
Novo publicly cited HIMS's continued involvement in what they called illegal mass compounding and deceptive marketing of knockoff Wegovy, even as the shortage was ending. Yeah. So HIMS lost that direct, potentially preferential supply line for branded Wegovy. Now they have to rely on third-party wholesalers like everyone else, meaning higher costs again and vulnerability if there are allocation shortages.
And the reputational hit.
Significant. It potentially dampened HIMS's credibility with regulators and, crucially, other large pharmaceutical companies they might want to partner with in the future.
Okay, that sounds like a really tough situation.
Yeah.
What's the net effect on HIMS's strategic positioning from losing both the cheap compounded supply and the direct branded partnership?
It's substantial. The shift from compounded to branded GLP-1, just the drug cost alone, raises HIMS's acquisition cost by roughly 3 to 4 times per prescription. That directly compresses gross margins.
3 to 4 times. That's huge.
It is. Their supply certainty for branded GLP-1s is now dependent on wholesalers, making them vulnerable to rationing or allocation issues. The public fight with Novo could deter other potential pharma partners. And the increased regulatory scrutiny just adds to their compliance burden and cost, offsetting some of that speed-to-market advantage they had.
So it really dilutes some key competitive advantages they had: cost, leadership, and speed.
Exactly. Those took a direct hit.
But HIMS seems to be arguing they can still compound semaglutide, relying on a personalization exemption. Does that argument actually hold water legally, especially given the scale they operate at? It sounds like trying to fit a square peg in a round hole.
That's precisely the core tension, and it raises a huge legal question mark. Now, legally, Section 503A of the FD&C Act does allow a pharmacy to compound a drug that's essentially a copy of an approved one if, and this is critical, the prescription specifies a change that produces a significant clinical difference for that specific patient, and it has to be documented.
Okay, so what's HIMS claiming is the significant clinical difference?
They argue their clinicians prescribe slightly different bespoke maintenance doses, like 1.2 milligrams weekly instead of the standard steps or other intermediate doses. Or they might use buffered diluents in the formulation, claiming it reduces GI side effects. They argue this constitutes the necessary clinical difference.
So does the FDA agree with that interpretation?
That's where it gets very tricky. FDA guidance states that compounded doses within plus or minus 10% of an approved strength are generally presumed not to create a significant clinical difference. HIMS's intermediate doses might fall near or within that range.
The 10% rule.
Also, and this is crucial for HIMS's scale, if a pharmacy fills 5 or more identical prescriptions for a compounded drug within a 30-day window, the FDA presumes it's basically mass production, not individual personalization. The burden then shifts entirely to the pharmacy to prove, with documentation, the specific individual need for each and every one of those prescriptions.
5 identical scripts in a month. HIMS must be doing thousands.
Exactly. Their platform markets preset intermediate doses to many subscribers, and they ship thousands of similar, if not identical, compounded kits monthly. Courts have also tended to accept the FDA's 10% rule as persuasive in past cases against compounders where the patient-specific rationale was weak.
So the bottom line on this personalization argument.
The bottom line is, while it might be legally defensible in theory for a truly individual, case-by-case situation with extensive documentation of a unique clinical need, HIMS's scaled, standardized, low-price offering makes meeting that high evidentiary standard incredibly difficult, probably impossible at their volume.
It exposes them
To significant regulatory risk, civil liability risk, as Novo Nordisk's lawsuits demonstrate. Just tweaking the dosage slightly is unlikely to be sufficient protection given the FDA guidance, the documentation requirements, and the sheer scale of their operation. It looks more like manufacturing than traditional compounding.
Okay, that clarifies the compounding dispute significantly. Let's shift gears back to their recent performance. Their Q1 2025 earnings call. Despite these headwinds, how did they perform financially?
Well, as we touched on, they actually started 2025 with really strong momentum despite the looming regulatory changes. Revenue more than doubled year over year to $586 million. Adjusted EBITDA nearly tripled to $91 million, hitting that 16% margin.
And subscribers
grew to nearly 2.4 million, with over 1.4 million, that's well over half now, using personalized solutions.
Okay, so the top line and bottom line look strong in Q1. What else stood out in terms of underlying business trends?
Yeah, a few key things. First, personalization is clearly working as a strategy. Over 70% of new subscribers in Q1 opted for a personalized solution. In areas like dermatology, it was over 80% of subscribers using personalized options, driving really strong, like 50% plus year-over-year subscriber growth in that category.
So customers are buying into the personalized approach.
Seems so. Second, the sexual health transformation is interesting. This was their original legacy business. They're successfully shifting it from just on-demand purchases to daily personalized subscription offerings. That now accounts for nearly 40% of their sexual health subscribers.
And why does that matter?
Because those daily users show a nearly 10-point improvement in retention in their first year. They stick around longer. While the transition causes some short-term choppiness in growth figures, they see it as a key driver for more durable, long-term revenue.
Makes sense. Better retention, higher lifetime value.
Exactly. Third, weight loss is obviously a major driver. It became one of their largest specialties in just 18 months. Even with the Novo dispute, they've added liraglutide and are sticking by their goal to meet or exceed their $725 million weight loss revenue target for 2025 by offering a mix oral kits, liraglutide, and still that personalized semaglutide where they argue it's clinically justified.
Still pushing forward on weight loss then.
Absolutely. Fourth, ARPU growth, that monthly online revenue per average subscriber climbed to $84. That's up over 50% year over year. Huge jump.
But you mentioned that might moderate.
Yes, they flagged that themselves. As they transition away from the lower cost compounded semaglutide towards potentially higher cost alternatives or branded options, that rapid ARPU growth is expected to slow down.
Okay. What about costs? Marketing.
Record marketing efficiency. Marketing spend was down to 39% of revenue in Q1. That's an 8-point improvement year over year, even with big spends like the Super Bowl ad.
How'd they manage that?
They attribute it to better retention from those personalized solutions. Loyal customers cost less to keep and growth in lower-cost organic channels like word of mouth or search traffic.
Smart. And operational costs.
Seeing improved operational leverage and cash flow, better efficiency in general admin costs operations,
Yep.
mainly due to automation and that vertical integration paying off. This generated strong cash flow from operations, $109 million, and free cash flow, $50 million. They ended the quarter with a healthy $323 million in cash.
Good cash position. And investments.
Significant CapEx investments. They spent $59 million just in Q1, primarily on expanding that fulfillment footprint towards the 700,000 square foot goal, boosting automation to handle thousands of SKUs, and building out sterile fulfillment capacity, plus investments in those lab diagnostic capabilities.
So investing heavily in the infrastructure to support the growth plan.
Exactly. Laying the groundwork for that 2030 vision.
And what about the outlook? What did they guide for the rest of 2025 and beyond?
For Q2 2025, they guided revenue between $530 million and $550 million. For the full year 2025, the range is $2.3 billion to $2.4 billion in revenue.
Slightly lower than Q1 run rate for Q2, maybe reflecting some of that GLP-1 transition?
Potentially, yes. Or just conservatism. The adjusted EBITDA for the full year is guided between $295 million and $335 million. And that long-term target remains firmly in place. $6.5 billion in revenue, $1.3 billion in adjusted EBITDA by 2030, driven by, all those pillars: deeper personalization, specialty expansion, better subscriber experience, partnerships, global reach.
Still aiming high.
Yeah.
Now, this raises an interesting thought. You mentioned their cash pay model multiple times. Here's a company so focused on personalization, on patient experience, yet they operate largely outside traditional insurance. Is that a deliberate choice?
It absolutely seems to be a deliberate strategic choice. The company leadership, particularly the CEO, has expressed very low interest in integrating insurance.
Really? Why not? Seems like a huge potential market.
They view insurance integration as inherently complicated, inefficient, and often frustrating for consumers. Think about navigating prior authorizations, formulary restrictions, deductibles.
Yeah, it can be a nightmare.
Exactly. And their argument is, especially with high deductible health plans being so common now, many consumers end up paying significant amounts cash out of pocket anyway, even with insurance.
True, until you hit that deductible.
Right. So HIMS's goal is to offer care at a straightforward cash pay price that's often equal to or even cheaper than what many people would pay as an insurance copay or towards their deductible. It's a philosophy of putting the consumer and their wallet first by simplifying the transaction.
Interesting. A bet on simplifying the financial side of healthcare access.
A big bet, yes. Against the grain of much of the industry.
Okay, so looking ahead as we wrap up this deep dive, what are the absolute most important factors for you to keep an eye on when it comes to HIMS and HERS?
Yeah.
If you had to pick the top things to watch.
All right. Based on everything we've discussed, here's what I'd be watching most closely, sort of in order of importance. Number 1, unquestionably, is the regulatory environment for compounded medications. Can they continue offering personalized GLP-1s under 503A? Any further regulatory tightening could seriously disrupt a key, fast-growing revenue stream. That's paramount.
Okay, regulation first.
Second, competitive dynamics in metabolic health and the GLP-1 market. More competition, especially from players who do work with insurance or new pharma partnerships emerging that will pressure their pricing and customer acquisition costs.
High for weight loss patients.
Exactly. Third, execution of fulfillment and infrastructure expansion. Can they actually build out and efficiently operate that massive 700,000 square foot facility network, including complex sterile compounding? It's crucial for margins and just keeping the operation running smoothly at scale.
Logistics and operations. Got it.
Fourth, customer retention and lifetime value from personalization. Can they keep proving that personalization leads to stickier customers who spend more over time across different health categories? That's key to their whole margin expansion story.
Proving the model works long-term.
Right. Fifth, lab diagnostics and specialty expansion execution. How quickly do customers adopt the at-home lab tests? Can they successfully develop and scale treatments in complex areas like hormone health? These are key diversification plays.
New growth engines.
Precisely. Sixth, AI and technology platform enablement. How effective are MedMatch AI and those virtual assistants in the real world? Do regulators accept them? Does it actually improve scalability and efficiency? The jury's still out on the real impact.
The AI promise versus reality.
Yeah. Seventh, marketing ROI and subscriber acquisition efficiency. Can they keep acquiring customers efficiently as the market gets more saturated and maybe ad costs rise? Maintaining that quick payback period is vital.
Keeping growth affordable.
Eighth, the macroeconomic environment and consumer spend elasticity. As a mostly cash pay service, how sensitive are they if the economy weakens and people cut back on discretionary healthcare spending?
Recession risk.
Always a factor for consumer businesses. Ninth, pharmaceutical partnership continuity and expansion. Can they repair relationships, like the one broken with Novo, or forge new ones? Access to branded therapies might become increasingly important.
Building bridges with big pharma.
Or finding alternatives. And finally, 10th, just general legal and reputational risks. Lawsuits, potential adverse events from compounded meds, getting bad press, negative media scrutiny. Anything that damages brand trust could really hurt subscriber momentum.
Okay, that's a comprehensive list. A lot to track there.
It's a complex company in a dynamic space.
What an incredible deep dive. It's really clear Hims & Hers is attempting something truly ambitious here, transforming healthcare delivery. They're building this vertically integrated, tech-forward platform aiming for personalized care for the masses. And, they have shown they can execute on big goals in the past.
Indeed, they have. But as we've discussed extensively, that regulatory landscape, especially for personalized compounded medications like GLP-1s, it remains a dynamic, high-stakes battleground. And that directly impacts their cost structure, their competitive positioning.
Yeah.
Their future growth really hinges not just on continued innovation, but critically on their ability to navigate these incredibly complex regulatory and competitive pressures, all while maintaining that direct-to-consumer trust they've worked so hard to build.
So here's a final thought for you, the listener, to consider as you think about Hims. In a world where access to care is often fragmented, complex, expensive, can a company truly disrupt traditional healthcare delivery by focusing almost purely on personalization, affordability, and a direct-to-consumer model? Or will the existing healthcare infrastructure, the powerful incumbents, and those complex regulatory forces ultimately limit how big something like Hims can scale? It's a really fascinating question, not just about this one company, but maybe about the future of health itself.
This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.